Hello and welcome to the Magellan Global Opportunities Fund quarterly update. I'm Laura Mitchell, Key Account Manager at Magellan Investment Partners, and today I'm joined by Alan Pullen and Ryan Joyce, Portfolio Managers for the strategy. Global equity markets surged to record highs over the last quarter. What have been the key drivers and how sustainable are these returns?
Yeah, no, that's the key question because markets are obviously on a tear and there's been some good macro news. So obviously last quarter we were very worried about what was happening in the Middle East and potential impact of high oil prices on inflation, on the consumer, and would that have some impact on markets? We have seen a muddled settlement there. It's been clear that Donald Trump does not want to re-escalate there. Well, it's trying to avoid that. So, still a bit of toing and froing to go, I would say, in that situation. But the risk from high energy prices appears to have receded. So that's been a genuine positive for markets over the period. But if I'm honest, the real driver of the surge of returns has been semiconductors and the data center supply chain. And that's where I'm a bit more concerned. This is clearly heading into more speculative bubble-like territory, I would say. We've seen a huge increase in June alone. The semiconductor index for the S&P 500 was up almost 50%. And that is kind of surpassing the kind of moves we saw in the dot-com bubble period. We're seeing record retail inflows into that area. And it's really, at the moment, being driven by momentum. So the momentum factor is delivered record returns, kind of equivalent to what we saw in that dot-com bubble era. Individual stock moves are kind of crazy. Micron, it's almost tripled kind of in that period. Intel, AMD, really anything with exposure to the data center supply chain is really on a tear. Not being driven by fundamentals now, just being driven because the prices are going up. That extends beyond some of the chip stocks, which are quite popular, into kind of energy stocks, into industrial stocks, stocks like Caterpillar, which we think of as those huge machines doing construction. They're on a tear because they supply gas turbines as well into the data centers. So this is concerning. We are big believers in AI, and the adoption is coming. We believe we've got some good exposure to AI as it continues to develop. But these moves are not based on fundamentals. They are bubble-like, they're highly concerning, they're based on greed. And for us, we think it's time for investors to start to be really cautious because these investor moves are not based on fundamentals. The portfolio did underperform because we lack exposure to those more speculative stocks being driven by momentum. Positive returns, and we're still pretty positive on the portfolio and the stocks in there. But we did underperform because we are avoiding this. I think it's been pretty important for investors to think about their exposure at the moment to semiconductors, to the AI supply chain. It is a very large part of the S&P 500 now. Semiconductors alone a few years ago, about 5% of the index, now 20% of the index today. So if you are in the broad market, you are heavily exposed to this bubble and you need to be careful.
Thanks, Al. Over to you, Ryan. The portfolio still holds large positions in companies such as Amazon and Microsoft. Given the concerns that Al's just mentioned regarding some AI plays, why do you still own these companies?
Absolutely. So, a lot of the companies Al talked about are what we would call the picks and shovels. So they're in that input supply chain. On the other side, you have the spenders, which are your Amazons, your Microsofts, your Googles, and that spending has been going up and up and up. Now, in the near term, that is supporting earnings of some of those businesses. But what we see in these businesses, the hyperscalers, is that they're building a much more sustainable earnings base on which they're going to generate returns over time. And our preference for them comes back to our investment philosophy. We're interested in investing where we have conviction in high quality businesses with valuation discipline. And for us, they tick all of those boxes at the moment. If we start with quality, there's a lot of dynamic things happening and change happening in that supply chain. What we have confidence in is that these leading cloud providers are going to be the leading cloud providers of tomorrow, with AI workloads supplementing and adding to their traditional workloads. whilst there's some uncertainty around what the exact ROI will be, we have confidence that they will generate a positive ROI. And a lot of that confidence is based on things that, the advantages they already had. So that's the existing customer base, the enterprise sales force to support them, the customer workloads and data that already exist with them, their investments in custom silicon, the investments they've made in the platform that make it easy for customers to come to them and have everything they need in one place. Also importantly, what we're seeing is actually giving us more confidence in their place there in the future. And so what I'm talking about there is, as we're seeing models get better and better, and as we're seeing clients and businesses spend more on AI, they're being a bit more discerning. They're saying, okay, where do I need the best model? Where do I not? I got to manage my costs here so I can invest over there. And what that leads to is them wanting model choice and choosing fit for purpose models. And where do you go if you need to do that? You go to the hyperscale platforms. Also, as we're seeing AI shift from more of these chat interfaces to agentic, you need more controls, you need more governance, you need more platform security. And that's the things that they've already invested in and can offer. So we're actually getting increasingly confident in the quality of those businesses. In terms of valuation discipline, I'd say we have high confidence that what they've invested in so far and what's currently in their near-term CapEx pipeline, that will be used. Al talked about we believe in AI proliferation and that it's going to get increasingly deployed through the economy. What we have less confidence in is that these businesses will keep spending about $1 trillion a year every year to build out that capacity. Now, as long as they're putting in some capacity, they're monetizing what they put in, we're confident these businesses will grow. We're confident that as they add more services around them, the returns will actually get better. And so we think there's very low risk that they're over-earning. And that's quite a contrast to that supply chain where we are seeing shortages, so we're seeing supernormal prices and supernormal margins. So for us, these offer a really attractive way to gain exposure to that AI proliferation, ticking the box on quality and ticking the box on valuation.
So I've got a question for you both. I might start with you first, Al. The AI debate is certainly moving markets, but putting that aside, what are some other opportunities that you are excited about at the moment?
Yeah, that's a great point, because the AI debate seems to be the only thing that most market participants care about at the moment. But there are obviously a lot of great stocks out there that are being neglected as the money flows into these hot AI stocks. An example is Bayersdorf. Tough German name to pronounce. We've made fun of me in the internal meetings as I've mispronounced it a number of times, but actually better known for their main brand, Nivea. So this is a global skincare brand. That's actually the market leading brand in skincare, and that's an attractive category given people do care about how they look. They're going to continue to care about how they look, so it grows above GDP. It is very defensible in down markets. They've got high growth dermatological brands as well, such as Eucerin. So this is a really attractive skincare company, GDP plus type growth. And because of some short-term executional issues, some pressure on the European consumer, as well as just this flow of money into AI, it's trading well below its typical multiple. So we see kind of almost 20% returns with relatively low risk in this company over kind of that 3 to 5 year time horizon. So absolutely, there are great opportunities out there as well.
Thank you, very interesting. And Ryan, anything from you?
I think Meta is particularly exciting at the moment. This is a business that has been a big beneficiary of AI, but is not trading like it. It's been able to leverage AI to increase engagement, to improve ad insertion, to make it cheaper to serve ads, which means people will pay more for those ads. And all of that has seen their revenue growth accelerate meaningfully. Now, one thing about Meta, and of course run by Mark Zuckerberg, is he does like to invest where he sees opportunities, and he does view AI as an opportunity. So whilst the cost to deliver that acceleration in revenue through AI was relatively modest, he's made a bit of a bet that AI can unlock more revenue and more opportunities for it in the future. And so rather than this massive fountain of revenue flowing through to the bottom line, he's taken a lot of that and reinvested. For us, we think that's opportunity. The market is treating that investment as if it's permanent and that it will not deliver any return. We don't think that makes any sense. Whilst Zuckerberg is happy to invest. He's also shown himself to be highly focused on value creation and the share price over the medium to long term. So we think, there's really two scenarios here. One, it doesn't deliver a return and that spend gets pulled back, and we think profits could be around 50% higher and make this business look incredibly cheap. Or it does offer returns, in which case the business is even more valuable and even cheaper. So we think it's another example of a business that has been left behind, more on concerns around AI overspending than anything else. And we think we're starting to see positive signals in terms of them monetizing that or showing discipline in that spend.
And just wrapping up for today, Al, I might get you to take this one. What is the outlook for markets and for the portfolio?
Yeah, well, I mean, that's the key question, isn't it? And obviously people need to be careful right here. Markets are at record highs. I believe part of this is a bubble. I'm taking that from the speculative activity that we're seeing in the market, and we know that can unwind fairly quickly. I can't tell you exactly when that will unwind, but that can unwind fairly quickly, as we saw back in 2000 and other bubbles throughout history. So it's time to, they say be fearful when others are greedy. I say be careful when others are greedy. And what we're seeing in the portfolio for the overall markets is it's very much time to be careful, because that could unwind quite quickly. Within the portfolio, though, I'm actually really positive, just given the neglected stocks that we've seen. On pretty careful underlying assumptions. We're looking to build these companies that are going to steadily grow shareholder wealth over time. Very few of them will double in a month, but they will grow that 10 to 15% over the long term. And we believe the portfolio at the moment is poised to deliver in that kind of range over the next kind of 3 years. So patiently but confidently building client wealth, which is what we really need at the moment.
Thank you, Al, and thank you, Ryan, for the fund update today. It's been very insightful. And thank you for watching. If you would like further information on the Magellan Global Opportunities Fund, please visit our website.